A short sale does not always begin with missed mortgage payments, a stack of collection letters, or foreclosure papers showing up in the mail. Sometimes it begins with PCS orders. Sometimes it is a job transfer. Sometimes it is a divorce, a change in income, a death in the family, or another major life event that forces you to move much sooner than you ever expected. And then you find out something you were not prepared for. You need to sell, but your home may not sell for enough to pay off the mortgage and cover the cost of selling. That is a stressful place to be. You may start wondering whether you're going to have to bring thousands of dollars to closing, rent the home even though you never wanted to become a landlord, damage your credit, or somehow end up in foreclosure because selling no longer looks financially possible. Those are difficult questions. But they usually become more difficult when the conversation starts too late. The earlier you understand the numbers, the more time you have to evaluate your options. A traditional sale may still be possible. Keeping the property may make sense. Your mortgage may offer another solution. And when those paths do not work, a short sale may become part of the conversation. A short sale is not something to panic over, but it is also not something to handle casually. The goal is not simply to get the house sold. The goal is to understand the financial problem, compare the realistic options, and choose the path that gives you the most manageable outcome moving forward. Before we even talk about whether you need a short sale, there is a more important question. What would actually happen if you sold your home today? A lot of homeowners look at an online home value estimate, compare that number with the balance shown on their mortgage statement, and assume they either have equity or they do not. Unfortunately, the math is not always that simple. Your mortgage balance is not necessarily the same thing as your final payoff. You may also have a second mortgage, a home equity line, property taxes, homeowners association balances, judgments, liens, late charges, accrued interest, attorney expenses, seller paid buyer expenses, repair credits, real estate compensation, and normal settlement costs. Closing has a way of inviting a few extra guests to the party. Let me give you a simple example. Let us say your home may sell for around $350,000. Your mortgage payoff is approximately $340,000. At first glance, it looks like you have about $10,000 in equity. Not a huge amount, but at least you are not upside down. Then we estimate the cost associated with selling, and those expenses come to approximately $24,000. Now the numbers look different. You have a $350,000 sale price. You subtract a $340,000 mortgage payoff. Then you subtract approximately $24,000 in selling expenses. Instead of walking away with $10,000, you may actually be looking at a $14,000 shortage. You had equity on paper, but you did not have enough net proceeds to complete the sale. That does not automatically mean you need a short sale. It means we need to understand the numbers before making assumptions. Employment, family circumstances, or another deadline. Waiting does not create equity. Waiting does not reduce your mortgage payoff. And waiting definitely does not make a lender move faster. Now let us talk about what a short sale actually means. A short sale happens when the money available from selling the property is not enough to pay one or more mortgage loans in full, and the lender or loan owner agrees in writing to allow the sale to move forward for less than the full payoff. In fact, the term may be one of the more misleading names. Let us say the mortgage payoff, other liens, and expenses. The word short refers to the shortage in the money. It does not mean the process will be short. In fact, the term may be one of the more misleading names in real estate. Let us say the mortgage payoff, other liens, and expenses. Total $390,000. The home is worth $360,000. That leaves a $30,000 shortage. If the homeowner cannot reasonably cover that shortage, the lender may be asked to accept less than the total amount due so the property can be sold. The lender does not have to approve that request. The fact that the homeowner wants to sell does not force the lender to accept less money. A short sale requires approval of the reduced payoff. Now, a short sale and a foreclosure are not the same thing. A short sale may be used to avoid foreclosure. During a short sale, the homeowner generally remains involved in preparing, marketing, and selling the property. In a foreclosure, the lender uses a legal process. The lender becomes involved because the expected proceeds are not enough to satisfy the mortgage debt in full. In a foreclosure, the lender uses a legal process. North Carolina commonly uses what is called a power of sale foreclosure. The lender cannot simply show up one morning, change the locks, and claim the house. There is a legal process. Court authorization is required before the property can be sold through foreclosure, and delinquent homeowners must receive a notice. Listing the house does not automatically stop foreclosure. Receiving an offer does not automatically stop foreclosure. Submitting paperwork does not automatically stop foreclosure. Submitting short sale paperwork does not automatically stop foreclosure. Certain federal mortgage servicing protections may apply depending on when a complete application is submitted. If foreclosure activity has already started, continue paying attention to every letter, hearing, and scheduled sale date. Do not assume no news is good news. Another common misunderstanding is that you have to be behind on your mortgage before you can even start asking questions. That is not true. You may be completely current. Maybe you purchased recently. Maybe you used a low down payment mortgage. Maybe the market changed. Or maybe life simply changed much faster than your home built equity. The time to start reviewing the situation is when you realize there may be a problem. Do not intentionally stop making mortgage payments because somebody online said so. Missing payments can affect your credit, increase the amount owed, and affect your ability to qualify for another mortgage later. Talk with your servicer. Explain the situation honestly. Now, before deciding that a short sale is the answer, you need to figure out which direction you are actually trying to go. Do you want to keep the home, or do you need to leave? Under federal tax guidance as of July 2026, the principal residence mortgage debt exclusion generally is not available for discharges after December 31st of 2025. Other exclusions like bankruptcy may apply. Let us start with options that may help you keep the home. Possible options include a repayment plan, forbearance, loan modification, or partial claim. A repayment plan allows catch-up. A loan modification changes terms. The important question is not simply whether the new payment is lower. The important question is whether the new payment is actually sustainable. If you have an FHA insured mortgage, you may have access to FHA specific options. Those may include a standalone partial claim, a loan modification, or a payment supplement. In FHA partial claim, the overdue amount generally becomes an interest-free subordinate lien. You may not have to make payments right away, but the debt did not disappear. It must be repaid upon sale. If you have a VA-backed mortgage, contact both your mortgage servicer and the Department of Veterans Affairs. VA loan technicians can help veterans understand their options. VA launched a new program. Veterans can contact a VA loan technician at 877-8273-702. That number again is 877-8273-702. Refinancing may also be worth reviewing if you still qualify, but refinancing is not magic. Another option is keeping the property as a rental, but the decision needs to be based on actual numbers, not the hope that rent will cover the mortgage. Consider taxes, insurance, management, vacancy, and repairs. A property that rents for the same amount as the mortgage is not necessarily breaking even. The roof does not care that the rent barely covered the payment. Renting can create a long-distance debt. Now let us talk about the second path. You need to leave the home. The question becomes, what is the least damaging, realistic way to exit the property? A traditional sale is simpler. Determine whether a traditional sale is still possible. The property may be worth more than you expected. Some expenses may be negotiable. Some homeowners choose to bring money to closing. Look at the full picture. Another option is a mortgage assumption. Some government-backed mortgages are assumable. An assumption allows a qualified buyer to take responsibility for the existing mortgage. FHA and VA loans are assumable. For a VA assumption, there are two separate issues: release from liability and substitution of VA entitlement. Those are not the same thing. Restoration requires substitution. Do not assume entitlement restoration. When the home cannot be sold through a traditional transaction and you cannot cover the shortage, a short sale may provide a path. Another possible option is a deed in lieu of foreclosure. This involves ownership transfer. A deed in lieu is not simply handing the lender the keys and walking away. And when the mortgage problem is part of a much larger financial crisis, a bankruptcy consultation may be appropriate. Bankruptcy is a legal decision. Now I want to spend a few minutes on something especially important in military communities. The property must have been the service member's principal residence when the PCS orders were issued, and the required documentation has to be provided to the mortgage servicer. The program has delinquency rules. Under the current FHA program, participating lien holders release their liens and forgive the deficiency balance. FHA rules also prohibit requiring a borrower cash contribution for loss mitigation. Now let us walk through how a short sale generally works. First, determine the likely shortage. You need a realistic estimate of the home's market value, the mortgage payoff, and other liens. Estimate selling expenses. Second, contact the mortgage servicer. Ask for info about all available loss mitigation options. The servicer may request hardship explanation, proof of income, bank statements, and tax info. Complete apps only. Third, review the alternatives. Can you afford to keep the property? Can you complete a traditional sale? Would renting make sense? A short sale should be a decision, not a reflex. Review all assistance programs. Fourth, prepare and market the property. The goal is to obtain a legitimate offer supported by the market. A short sale does not mean intentionally pricing below value. The lender reviews appraisal and comps. Fifth, Submit the offer and required documents. If several debts exist, more than one approval may be required. Second mortgage, HOA lien, tax lien. Approval from the first doesn't clear everything else. Sixth, the lender evaluates the transaction. They review property value, purchase price, expected proceeds, and investor requirements. There is no universal approval timeline. Missing docs delay review. And seventh, review the written approval. The approval addresses price, lender net, closing date, deficiency treatment, and other conditions. Those documents control the terms. Do not rely on verbal summaries. Now let us clear up a few things homeowners often misunderstand. First, the lender does not own the home simply because you are discussing a short sale. You remain the owner until title transfers. Second, a short sale is not automatically a discounted sale. The lender generally wants a price supported by the market. The shortage exists because of mortgage balance, liens, and selling expenses. Third, a second mortgage does not disappear because the first lender approved the transaction. A second mortgage or home equity line may also need to approve the sale and release its lien. Liens must agree. Fourth, releasing a lien and forgiving debt are not always the same thing. Lien release allows transfer. Debt forgiveness deals with whether the lender can pursue the unpaid balance. Written approval terms control. North Carolina has laws that limit deficiency judgments in certain foreclosure situations, but those protections do not create one blanket rule. Have a North Carolina attorney review remaining liability questions. Now let us talk about credit. There is no universal number that tells you exactly how much a short sale will lower your credit score. Anyone promising an exact number without reviewing your profile is guessing. Missed mortgage payments cause substantial damage early. Negative credit info may remain for several years, often up to 7. But reporting time is not the same as the waiting period for another mortgage. So can you buy another home after a short sale? Possibly. A short sale does not permanently prevent future ownership. Eligibility depends on mortgage type, time since sale, history, credit, income, and debts. FHA commonly applies a 3-year period. Fannie Mae conventional financing generally uses a 4-year period, with possible 2-year exceptions for documented circumstances. Freddie Mac typically applies 4 years. Official VA underwriting guidance does not impose one blanket mandatory waiting period just because a short sale occurred. The lender still evaluates credit history, payment history, and income. Risk matters. A short sale involving a VA loan may affect future entitlement. If VA pays a guarantee loss, the amount may remain charged against entitlement. Full restoration generally requires repayment of that loss. Obtain a COE. Now we need to talk about taxes. When a lender forgives debt, some or all of the canceled amount may be treated as taxable income. The lender may issue a Form 1099-C. Exclusions and exceptions apply. Under federal tax guidance as of July 2026, the principal residence mortgage debt exclusion generally is not available for discharges after December 31st of 2025. Other exclusions like bankruptcy may apply. The tax result can depend on whether debt was actually canceled, the amount forgiven, and how proceeds were used. Do not assume forgiven debt is tax-free. This conversation belongs with a professional. So is a short sale always better than foreclosure? Not automatically. Compared with foreclosure, a short sale generally gives the homeowner more involvement in timing and marketing, but it still affects credit and taxes. The correct comparison depends on financial hardship, property value, debt, foreclosure timeline, and long-term goals. The purpose of discussing a short sale is to determine the most manageable answer. So what should you do first? Start with the facts. Determine the home's realistic market value. Do not rely only on an automated estimate. Obtain current mortgage and lien information for all your loans. Estimate the true cost of selling. Account for transaction expenses, taxes, and repairs. Decide whether you want to keep or leave the property. Contact the servicer early and ask what options apply. Then use the appropriate professionals: real estate professional, HUD counselor, VA loan technician, NC real estate attorney, CPA, or tax professional. No one person provides advice outside their expertise. North Carolina homeowners can obtain free counseling through the State Home Foreclosure Prevention Project. The statewide number is 1-888-4428-188. Help may be available early or late. Contact them. Finding out you may not have enough equity to sell can be overwhelming, especially when the move is not optional. PCS orders, job transfers, or life changes require decisions that weren't part of the plan.